continue on, we'll just break this up. I'll just have Jonathan break this up into 3 different pieces. Okay, let's look at other studies. All right, the size effect. Studies indicate that smaller company stocks outperform large company stocks, even adjusting for risk. Okay, so what kind of stocks are we talking about? Well, what we call the neglected firm effect. Okay, studies show that the stocks of companies that have little research coverage, the brokerage firms just are not covering these firms. Why? Because they're not doing a whole lot of investment banking business with them, so they're not interested in covering their stocks. And these stocks have little trading volume, and they generate, because they're not being heavily looked at, not many people are researching them, the expectations are not solid that are built into them, and so you have an opportunity to earn a superior rate of return. The market simply is not as efficient in this area of neglected firms. Okay? Remember that you need a lot of players for a stock or a market to be efficient. Okay, then let's look at stock splits. If you ever get into the stock business, you'll hear a lot about stock splits. All right, what do? Well, they make round lot purchases. What is a round lot? 100 shares of a stock. More affordable. Okay, so let's say you have 100 shares of a stock at $50. That's $5,000 to buy 100 shares. If the stock splits 2 for 1, that means for every two shares, every share that you have, you get an extra share. And it also means the market will reduce your stock price from $50 to $25. How much does it now cost you? If the stock price is 25 bucks, how much will it cost you to buy 100 shares of stock? 2,500. So more people can afford to buy 100 shares of stock. But studies show that buying after a split is announced does not result in superior returns. So I can't tell you how many people want to buy stocks when they hear they're going to split. And studies show that after the split is announced, that you do not earn a superior rate of return. All right, initial public offerings. People get all fired up about initial public offerings. This company's going public, let's buy the stock. Well, what we see is that the only people who consistently earn superior returns on initial public offerings are those who are allocated shares in the offering before the offering hits the secondary market. So you are buying the stock directly from the underwriter. You're not buying it on the market, from the market. Okay? If you can get allocated shares, then you will earn a higher rate of return. Okay? So an IPO that is expected to be in great demand, which means it's going to go up after it goes public, is almost always saved for the best customers of the brokerage firms, those customers who do the most business with the firm. Okay? So if you're a pension fund manager, an insurance company manager, a hedge fund manager, a mutual fund manager, you're doing a lot of business with the brokerage firm, you get first dibs on the public offerings. Okay? Remember this, if you are simply your average small investors and you are allocated stock in an IPO, that is a very strong indication that the IPO is not a very good deal. If it's a very good deal, the best customers will snap up that stock before you have a chance to get it. That's just the way it is. All right, unexpected world events. Studies show prices react too quickly to trade after the news becomes public. Unexpected world events. All right, let's look at the strong form. So we've looked at weak form, semi-strong form. Now let's look at strong form. The strong form efficient market hypothesis contends that stock prices fully reflect all public and even private information. This asserts that no group has special access to information and that all information is cost-free and is available to everyone at the same time. And if you believe that, then I have got some swampland in Antarctica that I want to sell to you. All right? Tests on this hypothesis focus on the groups that do have special access, like corporate insiders. These are people who have access to non-public information, like officers, directors, and large stockholders. They know what's going on in a company, okay? And guess what? These people consistently earn superior returns on their investments. They're not supposed to be trading, but they end up doing it. By the time the news of their trading activity becomes public, so they are required to post what their trading is, but there's a 30-day lag between what they report and when they've traded. It is too late for others to also join in on the superior returns. These guys always trade first, and you find out later, okay? Then we have stock exchange specialists. These are the people that work at the exchanges, and they have access to the limit order book. And as a result, specialists also earn superior returns on their investments. Then we have security analysts. Can an investor earn superior returns by trading on the basis of a recommendation of an analyst? There was evidence back before the laws changed that a limited number of superior analysts may have had access to information that led to superior recommendations and returns. I must admit that back in the 80s, when I was an analyst and covered Arkansas companies, I developed a very good relationship with the management teams at several Arkansas firms, and I got a hold of information that was not insider information. The laws and rules were different, and I got a hold of information before other people did, and I published that information and made recommendations, and people who followed my recommendations did better than the people who did not. But that's before the rules changed. So the rules concerning information disclosure by companies have gotten much more stringent since these studies were done, okay? Then we have money managers. So you don't have superior analysts anymore. Then we have money managers. Most managers cannot beat a buy and hold strategy. I've said it many, many times. Less than 1% of professional money managers beat their benchmark over a 20-year period of time, okay? So remember, you hire a money manager to structure an appropriate portfolio, not to beat the market. I gotta sneeze. Is it gonna happen? Oh, I don't know. Did I beat it back? Yes. It held off. Success. All right. I'm ready to rock and roll. Let's continue on. All right. Let's look at technical analysis. What is technical analysis? Well, a technician believes that you can predict future stock price moves and returns by looking at past price and volume data. Okay? They believe trading rules can be used to exploit these patterns. If you have access to the patterns, then you can predict where the stocks will go in the future. Okay? Technical analysis is in direct conflict with the efficient market hypothesis. You either believe that markets are efficient or you don't. Okay? Then we have fundamental analysis. Okay? Fundamental analysts believe that at any time you can derive what we call an intrinsic or real value for the market and or for individual securities based on understanding the relevant variables that affect valuation. What are these variables? Well, economic growth, interest rates, inflation, and earnings sounds like the arbitrage pricing theory. Okay? However, you must accurately forecast movements in these variables to earn superior returns. Okay? And most firms can't, most people cannot do that. Most firms do not have superior analysts. They don't have superior investment managers or money managers. Therefore, the manager's primary job is to accurately assess the risk and return profile of a client and to structure a portfolio that addresses that profile. The implications of this are that investors should not hire and pay a portfolio manager to beat the market. You do not generate alpha. Sorry. Rather, a manager should be paid less and should add value by properly allocating assets, by selecting appropriate index investments, and we'll talk about passive versus active, and by providing advice in other areas such as budgeting, saving, taxes, insurance, portfolio management, education and retirement planning, and estate planning. Sounds like financial planning to me. Do not pay high fees for a manager to beat the market. That is not what's going to happen. Okay? All right, there you go. We're finished with that, and we'll move on. I hope I didn't give you too much information. Peace out. Shalom. Close up.